So today we're going to talk about the advantages of making an 83B election if you're a founder who has vesting, if your founder shares are subject to vesting. We'll also talk about 83B elections if you have received stock options and have an early exercise right that you'd like to exercise. So the 83B election is really a tax advantage that you can exercise in certain situations. What this election essentially says is, I want the IRS to tax me today on the value of everything I'm going to receive in the future at today's value, rather than the value at which I actually receive it. So maybe that definition is a little convoluted, but let's look at some examples, and I think it'll make it a little more clear. So say you're a founder in a company. On day one of the company is worth nothing. You and some friends, you get together, you form a company, and you decide that to protect each other from life happening and to protect the company, you want each other to subject yourselves to certain vesting so that your founder shares don't actually become yours fully until 4 years down the road. Typical vesting schedule is generally 4 years with a 1-year cliff, meaning you don't get any of your shares completely until after you've worked with the company for a year. And then each month after that first year, you get a portion of those shares, equal amounts, until the end of the 4 years. So from the IRS's perspective, if you have shares that are subject to vesting, they would say that you don't actually own those shares completely. If you don't own those shares until the end of year 4, then they would say, well, we've thought of a creative way that we can get some extra revenue. We're going to say that unless you make this election, those shares that you get in year 4, we're going to tax them to you as if you received those shares at the value of the company in year 4. So, day 1, you come in as a founder, you subject yourselves to a 4-year vesting schedule. You say, IRS, I want you to tax me on the full amount of my shares that I will have at the end of 4 years at today's value. Today's value, day 1 of the company's worth 0. You have 1,000 shares of a company that's worth 0, or it's at least equivalent in value to the amount of money that you put in, or the amount of contributions that you put in. So, do you have you gained any income over what you've put in? Answer's no. So what's your tax advantage to the IRS? 0. So you will make this election and you'll say to the IRS, I want you to tax me on everything today. The amount I paid for the shares is either 0 if you didn't contribute anything, or each of us put in $1,000 and we receive shares worth $1,000, therefore your tax consequence is 0. Great. Well, let's say you've got another founder. This founder comes in at month 6. He doesn't have money, and by this time, the company is worth $50,000. And let's say that there's 5,000 shares. So, instead of giving any money or giving anything, he receives 1,000 shares, or essentially $10,000 worth of income. Because he gets equity instead of cash. He's getting equity in the company for a promise of future services. He's subject to a 4-year vesting schedule. So clearly, he has a tax consequence here. He has to declare income of $10,000 to the IRS. So in his 83B election, he'll say, my shares are subject to a 4-year vesting schedule. I paid $0 for stock, and that stock was worth $10,000. So now the IRS says, okay, great. He got $10,000, so he needs to pay taxes on that $10,000. Perfect. Well, what happens if Founder 2 failed to file that 83B election? Well, let's say that this 4-year vesting schedule really vested in chunks of 1 year. That means that after year 1, he would receive 250 of his units. He would own those, and that would be $2,500 if the value of the company at 1 year and 6 months, or 1 year after he joined the company, remained exactly at $50,000. Well, let's say it jumped to $100,000. So now his 1/5 stake of $100,000 is $20,000. So at the end of 1 year, he would have a $5,000 tax liability. Well, I guess not a tax liability, but he would have $5,000 of income imputed to him because the company value increased. So he would have to pay taxes on that $5,000. At the end of year 2, or 2 years and 6 months, he would now, let's say the company value increased from $50,000 to $100,000 to $200,000. So now he would be imputed $10,000 of income. So now that's $15,000 of total income instead of the 10 originally. Let's say the company doubles in value again. You can see now that if the company doubled in value every year, instead of being imputed $10,000 of income at the beginning, it would have been 5, 10, 20, 30, or no, 5, 10, 20, 40. Sorry about that. So 40, 20, 10, that's $75,000 of income. So by making this election, he only had to pay taxes on $10,000 of income, rather than, based on our hypothetical situation, $75,000 of income. Now these are smaller numbers we're working with here. Imagine if company values really skyrocketed. If you went public, if you built a company to $100 million in 4 years, you can see the enormous tax advantages that would come from filing this 83B election. Similar concept applies to somebody who receives options in a company. And I'm sorry, I might have blocked your view there when I was showing this example. Often in a company, individuals will receive incentive stock options to incentivize them to work sometimes for reduced pay or to really motivate them to work harder in a company. When they receive these stock options, sometimes they'll have what's called an early exercise. Options like shares are often subject to vesting because we want to make sure that you're really sticking around to contribute the value for which you were being incentivized by getting these options. But an early exercise of options says, well, even though you may have to vest these options over 4 years, we're going to let you pay for them today, and in exchange for your payment, we're going to give you restricted stock, or stock that's subject to vesting, instead of options. You know, just like the founder shares examples we talked about here, the moment they exercise and they pay for the value of the shares, they wouldn't necessarily have income, but since those shares are vesting over time, and the value of those shares is inevitably going to increase, they'll want to make an 83B election to pay taxes at that point as well to save money. Since we're on the topic, we'll take a quick stab at why would anybody want to make an early exercise of their options? There's risks involved there. Maybe you pay for your options, that means you have to pay cash, and the company folds. If the company folds, you've lost your money, whereas if you have an option, you can wait to see if the company works or doesn't work before exercising, and then you may never have to be out cash. But the tax advantage is, the moment you exercise these options, you start the clock ticking, so you can be eligible for capital gains, long-term capital gains tax treatment, rather than short-term capital gains treatment, which is going to be similar to your ordinary income tax treatment. So that's a bit about 83B elections. Last point, and this is the big point. There is a time limit in which you must file this election. You can't forget about it. You have 30 calendar days from the date you receive your founder shares, or from the date that you exercise, you make your early exercise of options. 30 days. You have to file it with the IRS office in which you file your tax return, and then you need to keep a copy and file it with your tax return for the year in which you received those shares. Thanks.